Retirement readiness for those of you thinking of retiring. Today, we'll cover these 6 areas to give you a high-level overview of your pension benefit and the retirement process. We'll talk about how a defined benefit pension plan works, how your pension is calculated, when you can retire, and great features of the plan such as indexation and survivor benefits. We'll wrap up by highlighting some key considerations and resources and provide you with some helpful tips as you plan for your retirement. Let's start first with who is Wise Trust. As most of you know, Wise Trust was created a few years back when the WSIB employees' pension plan converted from a single employer-sponsored pension plan to a jointly sponsored pension plan, where the joint sponsors, WSIB and OCU, the Ontario Compensation Employees Union, appointed Wise Trust as the administrator of the plan. Our sole purpose is to administer and provide pensions for more than 10,000 workplace insurance and safety workers in Ontario. The members of our plan include active, deferred, and retired former employees from our 6 participating employers, the WSIB, our 4 health and safety associations, who are the Infrastructure Health and Safety Association, Workplace Safety North, Workplace Safety and Prevention Services, and the Public Services Health and Safety Association, as well as Wise Trust. The Wise Trust plan is a defined benefit pension plan that offers security and predictability today and a stable retirement income you can count on for your life, even if you live to be over 100 years old. A defined benefit or DB pension plan is a retirement plan where the pension at retirement is defined. It's calculated by using a formula that considers factors such as length of employment and salary history and not stock market returns. This means you'll be able to better predict what your monthly pension will be when you retire, and the longer you're an active contributing member of the plan, the greater your pension benefit will be. You won't have to make investment decisions or base your retirement plans around market performance, and once you retire, you'll receive monthly pension payments for the rest of your life. You'll have the security of knowing that you won't outlive your pension. Choosing when to retire is an important decision, and your Wise Trust pension is only one piece of the puzzle. Other sources of income, such as government benefits, which include Canada Pension Plan or CPP, other retirement savings, and retirement lifestyle choices all need to be considered. Your unique personal circumstances will help to determine when the right time is for you, and a key first step is taking the time to learn about your pension and the important role it has in helping you build your financial security for your retirement. So let's start by reviewing your retirement options under the plan. You have the flexibility to start receiving your lifetime pension as early as age 55, as late as age 71, or anywhere in between. The choice is yours. You can retire at age 55, but can also let your pension grow by continuing to work until you're ready to retire. Different retirement dates can impact your overall pension amount, with factors such as your age, eligibility service, and other considerations playing a role, so it's important to understand each of these options. You can retire with an unreduced pension on or after your normal retirement date, which is at age 65, or retire with an unreduced early retirement pension once you've met the plan's eligibility rules, which we often refer to as Factor 85 or the 60-20 rule. Or if you haven't yet reached your earliest unreduced retirement date, you can retire with reduced pension that can start as early as age 55. We'll look into each one of these options in more detail. The first day of the month following age 65 is what we refer to as your normal retirement date, which means you're eligible to receive an unreduced lifetime pension that's calculated in accordance with the plan formula, which we will discuss later on in this presentation. If you want to continue working beyond age 65, your pension will continue to grow until you do retire, or if earlier, to the end of the year in which you turn age 71, when you're required to start your pension, even if you continue working. You can choose to retire earlier than age 65 without any reduction to your lifetime pension if you qualify under one of these early unreduced retirement rules. Factor 85 is when your age, when added to your years of membership or pensionable service, equals at least 85 points. For example, you can retire as early as age 53 if you have 32 years of pensionable service. The 60-20 rule is when you're at least 60 years old and have at least 20 years of membership or pensionable service in the plan. The date at which you first become eligible for an early unreduced pension under the plan is typically referred to as your earliest unreduced retirement date. And you can find this date along with other key dates on your annual statement that you'll receive every year in June. Similar to your normal retirement date, if you want to continue working beyond your earliest unreduced retirement date, your pension will continue to grow since you'll earn additional pensionable service. If you don't qualify for an unreduced pension under the Factor 85 or the 60-20 rule, you could still retire anytime after age 55. However, your lifetime pension that you've earned will be reduced by 3% for each year that you retire prior to the date you would have qualified for an unreduced early retirement or turned age 65, whichever is earlier. This is to reflect the fact that you're starting your lifetime pension earlier and will receive it for a longer period. If you retire before age 65, you'll receive a temporary bridge benefit that's paid monthly in addition to your lifetime pension from the plan. An early retirement reduction is not applied to the bridge benefit. Your bridge benefit will continue to be paid until age 65 or until you pass away, whichever happens first. And it doesn't stop if you take your Canada Pension Plan benefit early. CPP benefits and pension benefits paid from our plan are completely separate and independent of each other. To better illustrate your Wise Trust pension benefits, you'll see here that if you retire early before age 65, you will have two parts to your pension paid from the plan, your lifetime pension and a temporary bridge benefit. Your lifetime pension and the bridge benefit will both start on your early retirement date and will both continue until the first of the month in which you turn 65, which at this point, the bridge benefit stops. Your lifetime pension will then continue to be paid for the rest of your life. If you retire after age 65, there is no bridge benefit payable. Along with the early retirement options, the pension plan also provides a bridge benefit, inflation protection, and survivor benefits for your loved ones. We'll talk through each one of these valuable key benefit features, but first let's do a quick overview of how your pension is calculated. Your lifetime pension is calculated by using the plan's formula shown here, which uses two main components, your best average earnings and pensionable service. Your best average earnings is based on your highest average pensionable earnings over any consecutive 60 months or 5-year period during your last 120 months or 10-year period before you retire. Pensionable earnings is essentially your base pay and doesn't include things such as overtime pay, pay in lieu of benefits, or performance bonuses. Your pensionable service is the total years, months, and days of service during which you or your employer on your behalf contributes to the plan, and this can include any eligible periods of service that you've purchased or transferred in from another pension plan, or periods that you're receiving short-term or long-term disability benefits from your employer's disability plan where you or your employer are contributing to the Wise Trust plan for those periods, or periods when you're receiving benefits from a WSIB claim, again, when you're contributing to the Wise Trust plan for that period. If you have part-time service, your pensionable service during that part-time period is calculated as a proportion of the pensionable service that a full-time equivalent employee would earn. In general, by working and contributing to the plan longer, you get more pensionable service and potentially higher earnings, which increase your overall pension in retirement. Now that you know the importance of pensionable service in determining the amount of your pension benefit, let's talk about how you may be eligible to get more of it. During your employment, there may be times when you take a leave of absence, such as a maternity leave or a leave due to an illness or disability. Or there may be a time when you've worked for a participating employer but weren't a member of that plan at that time. As a result, there could be gaps in your pensionable service when you weren't contributing to the plan, and purchasing those eligible employment periods is another way to increase your overall pension at retirement. So here's a full list of some of the more common employment service periods that are eligible for purchase. Periods where you were employed on a temporary contract basis but not enrolled into the plan, or leaves of absences covered under the Employment Standards Act, also known as ESA, such as maternity or parental leave, an unpaid absence due to illness or disability, or an educational or personal leave, an unpaid period due to a layoff or strike, and lastly, a period of temporary part-time employment where you were a full-time employee, then became part-time for a temporary period, and immediately returned to a full-time employment again. At that point, you're eligible to purchase the portion of service you would have earned had you been full-time during your part-time period. The cost to purchase depends on the type of pensionable service and when you're purchasing it. For certain unpaid leave purchase types, if you initiate the purchase when you return to work within the specified deadline, the cost to purchase is the contributions you would have made during that leave period. Other purchase types might require you to pay both your contributions along with your employer's contributions or the actuarial present value. It's important to note, however, the longer you wait to initiate any purchase, the more expensive that purchase will be. It's also important to note that purchases can only be made while you are an active member of the pension plan. So you'll need to initiate it before you retire or before you end your employment. Once you submit your retirement or leave your employer, the option to purchase pensionable service is no longer available. Log into My Pension Resource to view any periods available for you to purchase. We'll show you later on in this presentation how you can access this key feature on the My Pension Resource self-service tool, and you can run pension estimates to see how much pensionable service is allowed and how you can increase your pension in retirement. And if you're interested in making that purchase, you can also request an estimate for that cost, which will be sent to you within 2 to 4 weeks. Next, we'll talk about some really important key features of the plan, such as indexation and survivor benefits. The term indexation basically refers to the plan's inflation protection, also known as cost of living adjustments. When you retire, the negative impact of inflation on your pension will be partially offset by the plan's inflation protection, which will help your pension retain its purchasing power while the prices of goods and services increase over time. Once you retire, every January 1st, your pension will be inflation adjusted, or rather indexed, based on a formula set out in the plan. Here's the plan's rules or formula for indexation. You'll notice that different indexing rates or rules apply to pension benefits earned up to July 1, 2025, and after that date. When the plan converted to a jointly sponsored pension plan on July 1, 2020, the plan's indexation rules were updated to provide new indexation approach for pension benefits earned on or after July 1, 2025, 5 years after the conversion date, with the goal of ensuring the long-term sustainability of the plan. For pension benefits earned prior to July 1, 2025, the automatic or guaranteed indexing rate of 75% of the percentage change in the Consumer Price Index, also known as CPI, will continue to be applied for the lifetime pension. Bridge benefits paid up to age 65, earned prior to July 1, 2025, are not indexed. For pension benefits earned on and after July 1, 2025, the automatic or guaranteed indexing rate of 50% of the percentage change in CPI will be applied to both the lifetime pension and the bridge benefit. Additional conditional indexing increases above the automatic or guaranteed increase up to 100% of the percentage change in CPI may be granted if the funds permit as determined by the Wise Trust Board of Trustees in accordance with the funding policy. Each year in December, just prior to the January 1st increase, we advise pensioners what that increase will be. And just for further clarity, the indexation plan rules applied to pensions do not depend on when you retire. Rather, the indexation rules or rates applied to your pension depend on when you earn your pension, as shown here. Here's a very simple illustrative example. If you retired before age 65, let's say on July 1, 2029, with 25 years of pensionable service, that resulted in a total lifetime pension of $3,500 per month, plus a bridge benefit of $550 per month that's payable to age 65, as shown in the far left column. Since 21 years of your pensionable service was earned prior to July 1, 2025, shown in the middle column, the portion of your life pension earned before July 1, 2025 in the amount of $3,000 that's based on the 21 years would automatically get indexed by 75% of the percentage change in CPI. And your bridge benefit of $450, also based on 21 years, would not be indexed. Both your lifetime pension of $500 per month and bridge benefit of $100 per month earned after July 1, 2025, as shown in the last column, each based on 4 years of pensionable, would automatically get indexed by 50% of the percentage change in CPI. Additional conditional indexing increases above the 50% up to 100% may be granted as determined by the Wise Trust Board of Trustees in accordance with the funding policy.
We will now cover survivor benefits. Survivor benefits help provide financial security for your loved ones, whether you pass away before or after you retire. This benefit is provided to you at no additional cost and is available to your eligible survivors. The type and amount of survivor benefits provided under the pension plan depends on whether you have an eligible spouse or eligible dependent children, and whether you've started receiving your pension when you pass away. First, let's look at the definition under the plan for the three types of survivor beneficiaries and who qualifies under each. The first is an eligible spouse. Under the plan, this is defined as the person you are married to, or if you're not married, it's the person you have been living with continuously for at least 3 years, or less than 3 years if you're the parents of the child. An eligible spouse takes priority to survivor benefits over any other survivor beneficiary upon a member's death. This means your eligible spouse will automatically receive 66 and 2/3 of your lifetime pension for the rest of their life if you pass away before them. However, if on the date of a member's passing, a member has an eligible spouse that is living separate and apart from the member, that separated spouse does not have an entitlement to survivor benefits. The second type of survivor beneficiary under the plan is an eligible child. This is where you're the parent of a child who is either under the age of 18 or 18 years of age or older, but less than age 25 and attending full-time school, or 18 years or older and has a physical or mental disability that prevents them from earning a living. And the third is a designated beneficiary, or more than one beneficiary who may be eligible for benefits under the plan. Beneficiary can be a person, such as a child, or organization, such as a charity. If you choose to name multiple beneficiaries, any death benefit payable to the beneficiaries will be split as per the allocation on your designation form, or will be divided equally among your beneficiaries if there is no allocation provided. If you don't designate a beneficiary, or your beneficiary passes away before you, any benefits payable when you pass away will go to your estate. That's why it's so important that you review your pension beneficiary designations on a regular basis and update them as necessary to ensure we have the accurate designations on file for you. It's not necessary to name your spouse as your designated beneficiary since, as we mentioned, under a pension plan, your eligible spouse will automatically receive the survivor benefit. If you don't have an eligible spouse, or your eligible spouse chooses to waive their right to the survivor benefit, and you don't have any eligible dependent children at the time of your passing, your designated beneficiary is next in line for death benefits. Later in the presentation, we'll show you where to view your eligible spouse information and the pension beneficiaries you have on file, and how to obtain a spousal declaration and beneficiary designation form to make changes if or when needed. So what happens if you pass away after you retire and have an eligible spouse or eligible children? As mentioned, your eligible spouse, who is the spouse at the time your pension starts, will automatically receive a spousal pension equal to 66 and 2/3 of the lifetime pension you are receiving, and that percentage amount will continue for the rest of their life. If a bridge benefit is being paid to you at that time, the bridge benefit will not continue to your spouse, as only a pensioner is eligible for the bridge benefit. When you retire, you'll be given the option to choose a higher survivor pension to continue to your eligible spouse at either 75% or 100% of your monthly lifetime pension, which will result in a slight reduction in the lifetime pension that you will receive in retirement to reflect the additional benefit that would continue to your spouse in the event of your passing. And just to reiterate, it's your eligible spouse at retirement who remains entitled to the survivor pension that's payable upon your passing, even if you later divorce, separate from your common law spouse, or start a new spousal relationship. If you also have eligible children, your eligible children may each receive a pension of up to 10% of your lifetime pension for as long as they remain eligible children, which is until age 18 or age 25 if they're attending full-time school, or if they have a physical or mental disability that has prevented them from earning a living. The amount they receive, if any, does depend on the survivor option chosen at retirement and the number of eligible children. If you don't have an eligible spouse, but do have eligible children at the time of your passing, your eligible children will receive a pension equal to 66 and 2/3% of the lifetime pension you are receiving, divided equally among them, and again for as long as they remain eligible children. If you don't have an eligible spouse or any eligible children, your pension will not continue as it is only paid for your lifetime. However, if the contributions that you made to the plan plus interest are greater than the total pension payment you received in retirement prior to your death, a payment of that excess amount will be made to your beneficiary. Or if no beneficiary is named, the payment will be made to your estate. Survivor benefits for a spousal relationship beginning after retirement are not funded by the plan. Therefore, your pension would be actuarially reduced to provide survivor benefits to your post-retirement spouse. You must make an election to add the survivor protection within a 6-month period beginning 1 year after you begin a relationship with your post-retirement spouse. You may now be wondering what happens to the pension benefit you earned if you pass away before you start your pension. In that event, your eligible spouse will have the option to take it as either an immediate or deferred monthly pension, or take it as a lump sum commuted value payment, which can be transferred to their RRSPs. If your eligible spouse chooses an immediate or deferred monthly pension, and you also have eligible children, your eligible children may be entitled to receive a pension of up to 10% of your lifetime pension for as long as they remain eligible children. If you do not have an eligible spouse, but do have eligible children, your eligible children will receive a monthly pension equal to 66 and 2/3 of the lifetime pension that you had earned, divided equally among them for as long as they remain eligible children. If you don't have an eligible spouse or any eligible children, the value of your pension will be paid directly to your designated beneficiary. Or if no beneficiary is designated, the payment will be made to your estate. Now that we've covered the key features of the plan, let's talk about some important considerations and resources available to you when you're planning for retirement and what you need to do when you decide to retire. To start, visit My Pension Resource, which is your one-stop shop to your personalized pension information and self-serve tools that are available for all of our members at any stage of their career and even after retirement. My Pension Resource is easily accessed through our website, wisetrust.ca, by clicking on the login button located on the top right corner of the homepage. You can view your personal account, including your address and phone number, your pension spousal information and designated beneficiaries, update the email address that we have on file for you, estimate what your monthly pension benefit will be at various ages or retirement dates using your own up-to-date information. You can request a quote to purchase pensionable service. You can initiate your retirement online. You can view and download your latest annual pension statement and send and receive secure messages to and from our contact center. You can elect for paperless communication and access and download forms and much more. Once you retire, the site allows you to manage and update your personal account information, including your banking information. If you haven't already done so, here's how you can register for My Pension Resource. It just takes 5 easy steps. Go to wisetrust.ca and click on My Pension Resource in the top corner. Click on the Register Here link just below the Login button. Enter your ID, last name, and date of birth, and follow the instructions to create your username, password, and security questions. For enhanced security protection, you'll be asked to provide an email and phone number for multi-factor authentication. And if you have any issues, just call the Wise Trust Pension Contact Center. Once you've logged into the site, you'll see along the top banner that there are 4 main areas: the homepage, My Pension, Messages, and Profile. We'll take some time now to show you how to navigate through the site. On the right, the profile icon is where you can view the information we have on file for you, and that includes your eligible spouse information and designated beneficiaries. By clicking on the messages icon next to it, that's how you can communicate with our contact center team electronically by sending and receiving secure messages. When you expand the My Pension area, you'll see the main self-service functions of the site under My Pension Benefits, as shown here on the left side. This is where you can run pension benefit estimates, compare and save the estimate scenarios that you've run. You can initiate your retirement, view the periods of pensionable service that are available to you for purchase, and initiate a quote if interested in making a purchase of pensionable service. On the right, under the resources section, you will find a list of the online resources that are available to you. Here you'll find your last annual pension statement, the pension plan member guidebook, and commonly used forms such as the spousal declaration and beneficiary designation form. To make changes to your spousal information and pension beneficiaries, you'll just need to download the form, complete it, and send it to the Wise Trust Pension Contact Center. As you plan for retirement, you'll want to know how much your Wise Trust pension will be. So let's take a closer look at the Estimate My Pension Benefit and compare scenario functions, where you can get a personalized estimate of what your future pension looks like at any age, retirement date, or key milestone date, and how it can change based on different factors and possibilities, such as retiring earlier or later, or future salary increases. This tool will give you some insight into when you might want to start your pension. And remember, Deciding when to retire can impact your pension amount, so choose your retirement date carefully. You'll see it will also provide helpful information when deciding which surviving spouse option is right for your personal situation. To estimate your pension, you can choose to input either an age at which you'd like to retire, a specific date, or you have the option to select quick date. The quick dates refer to your key milestone dates, your earliest retirement date, your earliest unreduced retirement date, or your normal retirement date that we talked about. The system is smart enough to figure out the dates for you. You can also enter an annual salary increase rate assumption and the date of birth of your eligible spouse to see the surviving spouse options. And if you do have service periods available for purchase and want to know the impact on your pension if you were to make the purchase, click on the Model Purchase of Pensionable Service to select the periods you'd like to include in your pension estimate. You will see in this example that this member does not have any available periods of service for purchasing. Once you've entered all your assumptions, click on the Estimate Pension Benefit button. Here's what the pension estimate results look like. In this estimate, the member has an eligible spouse, so it details the surviving spouse options, also referred to as joint and survivor options. The estimated monthly lifetime pension amount that you'll receive at retirement is shown under the column labeled Payable to You. This option provides for the 66 2/3 of your lifetime pension to continue to your eligible spouse if you were to pass away before your spouse, where the amount is shown under the spouse column. You can also choose to provide a higher survivor pension to continue at 75% or 100%. Notice how the pension paid under the Payable to You column is reduced slightly from approximately $1,082 to $1,074 in this example. And that's to pay for the higher 75% pension amount that would continue to your eligible spouse. Similarly, under the 100% survivor option, the pension amount paid to you is further reduced to provide for 100% of your pension to continue to your spouse. As mentioned previously, at the time of your retirement, if you have an eligible spouse, you'll need to choose which surviving spouse option is right for you and your spouse based on your personal circumstances. As you've seen, electing an increased surviving spouse option will result in a slightly lower reduced monthly pension for you, but it will provide your spouse with additional financial security in the event you pass away first. These survivor option reductions are based on both your age and your spouse's age at retirement. And note, the reduction will not be reversed if your spouse passes away first. So when choosing your spousal option, some things to consider would be your age, family history, and health factors. Other things to think about when choosing a survivor option are, will your spouse have sufficient income or savings to manage their current and future living expenses if you pass away first? Does your spouse have their own pension or other sources of income that will last long enough to cover their expenses? Will your spouse rely on your pension as their main source of income? And if so, should you consider the higher 75% or 100% survivor option that won't significantly impact your lifetime pension? It's important to keep these things in mind while planning for retirement, as everyone's personal circumstances are different, and these can be deciding factors in choosing a survivor option. And in this example, you'll see that since the member's retirement date is before age 65, the member is also entitled to receive a bridge benefit paid until age 65 or death if earlier. But notice under the spouse column, the bridge benefit does not continue to the spouse if the member passes away first, since the bridge benefit is payable for the member's lifetime only. You can also choose up to 3 estimate scenarios to do a side-by-side comparison to see the impact of your varied assumptions. For example, you can compare what your pension would be if you retired at your earliest retirement date, your earliest unreduced retirement date, and your normal retirement date to see the difference in your pension. Or you can compare estimates to determine the impact of retiring 1 or 2 years earlier or even later than you originally planned, or see the impact of using different salary increase rate assumptions or the difference in your pension when you include a period of pensionable service that you're thinking about purchasing. As you can see, this is a really helpful tool when planning your retirement. Your pension from the plan is considered taxable income like most other sources of retirement income, such as CPP, OAS, your RRSPs, and registered retirement income funds. We are therefore required to deduct taxes from your pension payment from the plan based on basic federal and provincial income tax table rules. It's important to keep in mind that when using the pension estimate tool or when viewing any communication from us, the pension amounts displayed are estimated gross monthly pension amounts, unless noted otherwise, as the required income tax withholding has not yet been deducted. The income tax deducted from your monthly pension is based on the tax rules set out by the Canada Revenue Agency. If you'd like to estimate the tax withheld from your pension, you can visit canada.ca and search on Payroll Deduction Calculator, which is a tool that estimates the amount of tax that would be deducted from your monthly pension. When planning for your retirement, we strongly recommend getting qualified, unbiased advice to help with your overall retirement plan. A qualified financial advisor can help you determine how much retirement income you'll need to help you meet your retirement needs and goals. In addition to your Wise Trust pension, consider other sources of income like government benefits, personal retirement savings, or employment income from a part-time job, for example. You may receive CPP retirement benefits and qualify for old age security. Consider all your retirement income sources and personal circumstances carefully and obtain estimates before making any decisions. For more information, such as CPP benefit estimates, please visit canada.ca or visit Service Canada. And don't forget to contact your employer to determine if you are eligible for any post-retirement medical and dental benefits. If not, you may want to consider getting coverage elsewhere.
In addition, there are a few key reminders that we would like you to take special note of. First, always remember to keep your personal information, such as your mailing address and phone number, updated through your employer. This information is sent to us by your employer to ensure you receive important pension-related information. Also, you can update your personal email through My Pension Resource. You can do this under the Profile section. In the future, when you retire and you no longer work for one of our participating employers, it's important that you contact us directly to make any changes to your mailing, phone, or email address, either through My Pension Resource or by calling the contact center. We can't stress enough how important it is to keep your spousal and beneficiary information up to date at all times. Review your designations on a regular basis and update information accordingly. By keeping your spousal and beneficiary information up to date, you'll ensure that any eligible pension benefits will be distributed according to your wishes. You can view your current pension designations online under the Profile section on My Pension Resource. Note that these beneficiary designations are strictly for pension purposes and relate to your pension benefits only. They are not related to any life insurance that may be offered through your employer. Please contact the administrators of those benefits to update your designated beneficiaries under those plans. To make updates related to your Wise Trust pension, complete the pension spousal declaration and beneficiary designation form and return it to the Pension Contact Center and retain a copy for your records. You can upload a copy to the Message Center in My Pension Resource. However, the original must be mailed to the Wise Trust Pension Contact Center as we require a wet signature to complete the process. And of course, once you've made that big decision to retire, please remember to notify your manager. They will receive notification once you've initiated your retirement, but we encourage you to have these discussions together beforehand. So now let's talk about how you can initiate your retirement when you're ready. You can initiate your own retirement. To ensure you receive your first pension payment on time, put forward your request approximately 6 to 9 months prior to your desired retirement date by either calling the Wise Trust Pension Contact Center or initiating it online through My Pension Resource. The 6 to 9 months may seem a little excessive, but we ask this as it gives ample time for the contact center to prepare and send you your retirement package, time for you to review, gather the necessary documents and complete the required forms, and ask any questions that you may have along the way. You can initiate retirement, let's say 2 months prior to your retirement date, but keep in mind that you will likely not receive your first pension payment on your elected retirement date. However, once the contact center has everything in order, you will be set up to receive payments and will be paid retroactively. But do ensure you complete and return all required information within 90 days of receiving your package. Otherwise, we'll assume you've deferred the start date of your pension and you'll need to contact us later to initiate the start of your pension at a future retirement date. Once you've initiated your retirement, you should receive your retirement package within 1 month. Review the package, and if you have any questions, please call the Pension Contact Center. Here are some of the documents and forms that you will be asked to submit along with your completed retirement option election form. Proof of age. This can be a valid birth certificate, a valid passport, or a valid driver's license. Proof of your spouse's age. A completed spousal declaration and beneficiary designation form if there are any changes required. A completed direct deposit form with a void check. Please note that the plan does not provide direct deposit to bank accounts outside of Canada. If you live outside of Canada after retirement, you'll need to make arrangements with your Canadian bank to transfer or wire payments to your account in the country of residence as required. Completed the federal and provincial TD1 personal tax credit return forms. So these forms allow you to make adjustments to the amount of tax deducted from your Wise Trust pension. You can request that additional tax be taken to avoid owing additional taxes at year end. Since everyone's personal circumstances are different, it is important for you to consider the impact of taxes on your retirement income. We recommend you consult with a tax advisor or an accountant when you file your taxes to learn more about the allowable tax credits and other tax strategies, such as income splitting between spouses, that may be applicable to you. Return all of your completed forms and supporting documentation to the Pension Contact Center no later than 1 month before your scheduled retirement date to avoid any delays in receiving your first pension payment, though we highly recommend submitting your documents as early as possible. If for some reason there are incomplete forms that have been returned to the contact center or missing documents, the 6 to 9 month timeframe that we just discussed allows time for follow-up. When you've retired, there are some important things to keep in mind about your pension. Wise Trust pensions are normally paid on the first day of each month. However, if your banking institution does not process payments on weekends or statutory holidays, your monthly pension payment will instead be deposited on the first business day. Contact your banking institution to confirm timing of direct deposits on non-business days. As a retired member, you'll also receive a pay statement from CIBC Mellon, our pension payment service provider, for your first pension payment, which is currently delivered by mail. After that, pay statements will be sent to you only when there's a change to your net payment amount, banking information, or address of residence. It's a good idea to keep your first statement on hand for future reference. And each year in December, just prior to the January 1st indexation increase, we'll advise you what the increase will be. You will also receive a tax slip from CIBC Mellon, which is mailed out at the end of February of every year to allow you the necessary time to file your taxes. Once you've retired, you'll receive a biennial pension statement from us in June every 2 years. To update your banking information, visit My Pension Resource or call the Wise Trust Pension Contact Center team. Make sure you receive your pension payment in your new bank account before closing your old bank account. To change the amount of income tax withheld, complete the appropriate TD1 forms and send them to the Wise Trust Contact Center as well, either by uploading it to My Pension Resource or submitting it through mail. Change is part of life, even in retirement, so we ask that you keep us informed if you move, change your phone number, mailing address, or email address. When you retire, check to make sure we have your up-to-date personal email on file so that you'll continue to receive important updates from us. And lastly, please remember that the Wise Trust Contact Center should receive any power of attorney documentation or death notifications directly. In closing, if you have any pension-related questions, you can call or send a secure message to our contact center through My Pension Resource. The Wise Trust Pension Contact Center can be reached at 155-242-1526, and a representative will be happy to assist you. They are available Monday to Friday from 8:30 a.m. until 4:30 p.m. Please make sure you have your 5-digit employee or pension ID handy when you give them a call. And for more information about the government-sponsored plans and programs such as CPP and OAS, including if you qualify, how to apply, and for estimates, please visit canada.ca. If you're interested in more information about the plan, such as our funded status, our investment performance, our 2023 Highlights for Members report, which will be available on our website later this month, please watch out for a notification through email. And that concludes the retirement readiness presentation. For more information relating to your Wise Trust pension, please log on to My Pension Resource or call the Wise Trust Pension Contact Center. Thank you.